Welcome to this edition of Business Redefined. No platform covers taxation matters like we do. And pardon me today, I have a bit of a sore throat, but I'm getting over it and my voice a bit hoarse. But we shall navigate this session nonetheless. And we want to talk about the Finance Bill Report of 2022, which of course was tabled by the Finance and Planning National Committee, the National Assembly Committee of Finance and Planning, issuing a number of issues in terms of recommendations by way of the Finance Bill to the August House. We were expecting there would be deliberations in the August House this afternoon. They didn't take place. The indication is that this should be happening sometime next week. On set, I'm delighted to have Edna Gitachu, Tax Policy Lead from PwC. We have Robert Warero from Ichiban Tax Advisory and Business Consultancy, and Christine Kahema from Alpha Tax. Ladies and gentlemen, welcome on set. Let me start with Christine. Christine was here last week for the excise tax conversation, and you loved her, and we brought her back. Christine, in my experience reading through reports from the Finance and Planning Committee on the Finance Bill, I can't remember any other report which has shot down so many recommendations from the National Treasury. Do you share this assessment?
Thank you, Julian, for that question. You know, it's very interesting to also just review how that process went. It was interesting to see a lot of corporates, a lot of associations, and also a lot of individuals taking part in the process of public participation. And this is as provided under Section 118 and 119 of the Constitution. The level of engagement during that period was definitely very good. What we saw is that there were quite a number of proposals from very many stakeholders. The committee was ready to listen to all these proposals, and they more or less understood what businesses were going through. And I think that's the reason as to why we saw a lot of the proposals that were made by stakeholders being accepted. I wouldn't say 100%. There was definitely, maybe we could put it about 70 to 30%. And I think what we need to start focusing is on long-term proposals for tax increases, so that we are not doing it every other year. We've got a long-term goal, and we're saying, yes, we want to increase revenues. What else can we do, as opposed to having a yearly tax change? Because that definitely causes a lot of unpredictability and a lot of uncertainty. So I feel that most of the proposals were accepted, not because they were different from what has been done before, but because they were felt to be short-lived, as opposed to having a long term, and also taking into account that most stakeholders were able to demonstrate that if you increase the tax, you might get an increase in tax from that specific tax head, but many other taxes will go down, because businesses, as long as they do not thrive, you may actually have a tax reduction as opposed to a tax increase. So I think that was the essence of the conversations, and that's why most of the proposals that were made by stakeholders were accepted by by Parliament, and most of those that had been proposed by the National Treasury were actually rejected.
Let me come to you, Robert. Christine is painting a scenario of a very delicate trade-off by the Finance and Planning Committee. What is your sentiment, Robert?
Yeah, thanks, Julian. And I have to agree with my colleague here, Christine, because if you look at that report, a lot of the proposals that the committee has rejected or has perhaps, let's say, not accepted. You know, the committee is saying we think that this was a very ambitious proposal, or some of the proposals were very ambitious. And if you look at the amount that bill was supposed to collect, it was supposed to collect about 51.6 billion.
Yes.
Now, if you compare that with the previous year, 38 billion, and the year before that, about 37 billion, you can clearly see that they were ambitious. In fact, you look at the forward to the chairperson's report, and they say, we need a tax policy, and it goes to what Christine is talking about. We need a predictable tax environment, and this is what we are lacking. So, you know, interacting with the committee members, you could tell that they were struggling, because how do we justify raising this amount of money, especially in an election year, especially when you've got a lot of Kenyans who are complaining about the cost of living. Like Christina said, last year the number of stakeholders were about 51. This year there were 74. Clearly, there's been a lot of public participation, and I think the committee has had. So when I look at the overall, Julians, I think that, you know, for example, the ISPAC proposals, 6 out of 10 were accepted. So for me, I think it's a fairly balanced review by the committee.
Before I come to Edna, let me stay with you there. I like the graduation you have painted for us, going back 38B and slightly lower the year before. If I'm wearing the Treasury hat, I will tell you, look, in the preceding years, we didn't have the IMF revenue targets. So it only made sense that we came in with 50B, don't you think so?
Well, that's an interesting perspective, Julian, and it's a valid point. However, remember, Revenue Authority needs to collect somewhere in the region of 243 billion additional shillings. So surely, out of the 243 billion, the finance bill was going to come up with an additional 51 billion. That tells you that there's 190 somewhere that needs to come out from, and that I think is really what Treasury is saying, or the committee is saying. Can you go and whatever measures you're going to implement, whether it's additional audits or whether it's bringing a lot more people into the tax bracket, go and do that without necessarily increasing taxes.
Yeah. Let me come to you, Edna, with the very first question that I asked. What was your sentiment around the committee's proposals on the report?
Yeah, thanks, Julian. First of all, thank you for having me on your show, and to our viewers, a very good evening. I do agree with the comments that have been made by both Christine and Robert, and I think there were very good reasons for the Finance and National Planning Committee to drop a number of the proposals. And one of the reasons is around the economic circumstances that are currently facing us as a country. We are talking about the high cost of living, and Mwananchi is actually really struggling from that perspective. We're just recovering from the COVID-19 pandemic, and also facing pressures arising from the current geopolitical tensions in other parts of the world. So I think the committee may have considered all these, and the committee was also trying to cushion Mwananchi against the adverse economic effects that we are currently facing.
I see. Let me come to Christine. And when Edna talks about Mwananchi struggling, you might be aware that the latest inflation numbers just released this afternoon by KNBS is that headline inflation is now at 7.1%. That's the highest it's been in 27 months. Christine, Mwananchi is struggling. One of the issues which has sparked divided opinion around this finance bill is the issue of VAT on maize flour, sorghum, and I think cassava as well. What's the correct interpretation of what is actually in the bill? Because in my understanding, I thought it was a non-issue, but there are parties which went and presented the same issue before the committee.
Yeah, I think, Julian, that's because our finance bill, our taxes keep changing every other year. And if you don't follow that very carefully, there can be a little bit of misunderstanding. So let me provide some context with respect to this issue. So in the Finance Act 2020, what happened is that wheat flour and maize were actually categorized as exempt from VAT, but that's under the first schedule, but there was also a provision in the second schedule of the VAT Act, which is a zero rating schedule, that stated that it will be zero rated for 6 months, and when those 6 months lapse, the exemption status now takes into effect. That was in 2020. Then in 2021, the Finance Act 2021 brought in a specific provision zero rating the same items, that's maize and wheat flour. So that gave it its zero rated status. So this provision that is actually in the bill this year is a cleanup provision, because what they did is that when they made it zero rated, they did not remove the exemption status that was there through the Finance Act 2020. So that now has been cleaned up, removed, so that it is clear without doubt that maize is actually zero rated as provided for under paragraph 22 of the second schedule to the VAT Act.
Robert, let me come to you. And just for the sake of our viewers, could you help us distinguish the zero rating and the exempt status when it comes to VAT?
No, that's a good question, Julian. So in both scenarios, you don't charge any VAT. In other words, when you look at an invoice or the price of a good, there is no VAT charged on that supply. However, for VAT zero rated, the invoice will read 0% VAT, and because you're supplying a VATable item, only that it's VATable at 0%, you're allowed to claim your input VAT. And this is where it becomes important. So take, for example, somebody who is selling bread or wheat, what we are just discussing, wheat flour. Now, for you to manufacture this wheat flour, you have to necessarily incur electricity costs, and Kenya Power will bill you with 16% VAT on that power. Now, if you're supplying VAT zero-rated products, you are allowed to claim the input VAT that you've incurred from Kenya Power. However, if you're supplying exempt products, you're not allowed to claim the VAT from Kenya Power. And that means that the manufacturer will inbuild the cost of that VAT that they are not able to claim into the final product. And that's the reason why you'll hear professionals talking about exempting a product does not necessarily make it cheaper. because there's an element of the VAT cost that will be passed on. For example, another good example to give you would be when LPG was exempt at some point. Transporting it from Mombasa to Nairobi necessarily incurs VAT, that transport cost. So the retailers, you know, the OMCs would have to build in that cost because they cannot absorb it. And that's why even though at the end of the day you're not paying any VAT on that product, it's still more expensive if it's VAT exempt rather than VAT rated.
I see on that point by Robert. My director tells me we need to take a commercial break here. We shall be right back with a lot more on this conversation on the Finance Bill report of 2022. Stay tuned.
We asked Kenyan women to tell us what they look for in a lotion. Ladies, what is most important to you when buying lotion?
Smoothness, scent, glow.
Today, we are testing an expensive body lotion versus an affordable one. Ungenunua gani? Why pay more? Get great quality at an affordable price. It's just nicer and lovelier. Chagua, Kenya's #1 body lotion.
199, 200. Here it is. The treasure is down there. Well, start digging. Quicker. Dig quicker. Here, drink a Red Bull. That's better. Can you see it? How much is there? Hello? Have you found the treasure? Hello? Hello?
Red Bull gives you wings.
While prices of most items are skyrocketing, your favorite peanut butter is now available at reduced prices. It's made with 100% pure peanuts and a rich source of omega-6, helping you grow healthy and happy kids. Buy and enjoy Blue Band peanut butter at reduced prices today. Made possible through local farming in Kenya.
Welcome back to this conversation on Business Redefined. We are unpacking, well, attempting to unpack because the report is so laden we can't unpack it fully, but we are capturing snippets of the Finance Bill report of 2022 and what you should be focusing on. And before the break, we were discussing this issue of maize flour, wheat flour, and whether they should be subject to VAT if the report sails as it is. And we got thoughts from Christine and Robert. Let me now come to Edna Gitachi, who wants to couch it in a bit of a policy perspective. Edna.
Thank you, Julian. So I think the bigger question that we need to be asking ourselves, as a country, our national tax policy needs to spell out whether the basic commodities should be VAT exempt or zero rated. We should not be having this discussion year in, year out. And that's why we have all this confusion. So we need to have a very clear national tax policy which says that for basic commodities and describes what these basic commodities are, they should be excluded from the general principle of VAT, meaning they should be zero rated from a VAT perspective. But this can only be achieved through a very comprehensive national tax policy, which we are still waiting to see.
Well, my friends from the National Treasury, I know you're watching, so this conversation about the national tax policy, you've been having it time and again. But Emma, let me stay with you. Someone would ask, I mean, what was the import of the VAT Act of 2013? We thought the idea was to clean up some of these things.
You're right, Julian. And maybe I can just take a step back and give you a bit of background from a VAT perspective. So as my colleague Robert was trying to say, there are three categories of VAT. So ultimately, VAT has to be borne by somebody. So when goods are charged VAT, it means that the final consumer is paying that VAT. When it is exempt, as Robert has said, it is the businesses that are paying for this VAT. When it is zero rated, it is the government that is actually bearing this cost of VAT. So what we are saying in 2013, the intention was to reduce the list of exempt products and zero rated products and services. But what we saw is that I think after 2 or 3 finance bill cycles, the list has continued growing. And every year, without fail, if you look at the changes to the VAT Act, there are quite a number of VAT exempt or zero-rated products that are introduced. And again, still back to that national tax policy. That's why we need that, so that it's not like this year we are deciding we are going to zero-rate this product, next year it's going to be exempt. There must be a rationale for it, and it has to be spelled out in the national tax policy.
Let me come to Christine here, and now that you're talking about the national tax policy, one of the exciting things around this finance bill and the report itself is the discussion around excise. And I know we touched a bit on this last week, but what are some of the things which stood out for you? I remember when the budget was read and the CS said, there are a number of items which I'm proposing increase in excise.
Yes.
Have they been shot down, proposed for shooting down by the committee, or how is it standing?
Okay, interesting one on the excise one, because when the CS read the budget, he said that most of the excisable items will have a 10% increase from an excise tax perspective. Now, when you look at the specific items, there were two issues of concern. One was the increase was actually being based on an excise amount that had already been adjusted for inflation, something that was actually stayed last year by the courts. So that wasn't supposed to take into effect. So that in itself, if you were to look at it to the new rate that was being proposed, was actually resulting to about a 15% increase, because there was a 10% and then there's a 4.97 inflation adjustment for last year. So it was resulting into a 15%. And I think that was the major concern for most of the stakeholders who deal with excisable products, that a 15% rate is definitely punitive. Remember, excise is adjusted on two bases. One, there's what is provided under Section 8, where the CS can revise the rate, and then secondly, the inflation adjustment, which is a power given to the commissioner, subject to alignment with the CS and also Parliament, to increase for adjustment. So that was actually the major concern. We can't use excise increase as a way to continuously raise revenue, because it gets to a point whereby, and I remember my colleague last week spoke about the Laffer curve. You get to a point like the maturity point, that any other increase, you've actually taxed to maximum. Yes. Any other increase will result into a decrease in volumes, and a decrease in volumes will have an impact on VAT, will have an impact on the excise tax, will also have an impact on corporate tax. And what it also does is that it eats into the pot for investment, you know. So you're having businesses running without growing. I think the concern was, some of the reasons that are usually stated for a change in excise is for medical reasons, as we discussed that last week, and also as a way to deal with illicit trade. Yeah. But what happens is that as soon as you increase the tax, you're actually widening the bracket and making more, you're actually creating a platform for illicit trade. Okay. Because the difference between the genuine product and that is coming through the black market is definitely very high. So we need to get to a point whereby the tax has to have a reason, yes, but again, you cannot tax it to perpetuity. Let's think about what else can we do to ensure that we want revenues from that sector, yes. Why don't we create an environment such that that business thrives, increases sales, and you're able to get the tax that you're looking for, as opposed to using persistent increases in tax to raise the revenue, because that definitely affects investments.
Robert, let me come to you, and on the point that CK is raising about excise tax. I had this conversation with Lindstrom Kinoti from KRA, and he said the trend of using excise more as a revenue mobilization as opposed to a sin tax is a global trend. It's not a Kenya-specific affair. How do you respond to that?
Well, I think Kenya seems to be leading the pack as far as excise tax is concerned. And in all seriousness, if you think about it, we introduced the excise duty on financial services. Then regionally, they also introduced excise duty on these services. We introduced the excise duty on telephone services, mobile telephony. Again, it was introduced in the sector. So I think there's an element in which Kenya is ahead of the curve as far as that is concerned. And I think this is possibly where my good friend Lindstrom was coming from, because when I look at other jurisdictions that employ excise, it really was a sin tax. It was about what behavior do you want to curtail in terms of society. Because if you think about it, if you say that, for example, people are consuming this particular product and there is an ill in society, then we tax that particular product and ensure that we ring-fence the revenues from that product to address this issue in society. But if you think about the Kenyan scenario, we are actually collecting this revenue and it all goes to the exchequer and we are all very happy using it, which is, you know, okay. So I sort of disagree with that. The one thing that we have seen globally, though, is countries moving towards VAT. And it's because it's so simple to administer. Yeah. So the idea here is you tax people less on their income, their employment income, for example, or their corporate taxes. You know, you look at the UK, South Africa, their examples are many. So you tax them less, and then with the residual income, these people can consume and you can collect more from a consumption tax perspective. So VAT is what we've seen generally being used globally. But excise, I would not necessarily agree with that view.
All right. Let me come to Edna here. And one of the things which stood out for me in the report from the committee is that the recommendation that excise inflation adjustment be done once every 2 years. For those of us who didn't catch up with this conversation last week, just help us understand the import of that and what you think about it.
Yeah, thanks, Julian. So this is a very welcome move. And maybe for the sake of our viewers, I just want to break it down for them to be able to understand what is the importance of having an inflationary adjustment every so often, and then we can talk about the frequency. So this inflationary adjustment affects specific products where excise duty is charged based on quantities. What do I mean? So for instance, for every 1 liter of commodity Y, then I'm supposed to pay 20 shillings. Yeah. And that what the government is trying to do is to safeguard the time value of money. So the 20 shillings today will not be worth 20 shillings tomorrow. Yeah. So maybe tomorrow it will be worth 16 shillings for argument's sake. So through the inflationary adjustment, what the government does is to adjust for this 16 shillings time value of money to go back to the 20 shillings. So what has happened historically is that this has been done on an annual basis. Unfortunately, this has not factored in the economic circumstances of the country. So the proposal to move away from annual inflationary adjustment to every 2 years is a very welcome move, because then it's supposed to factor in the business environment. And a good example, right now we're talking about very high fuel prices. So you can imagine a liter is going for about 150 shillings. You can imagine if we decided that every year we need to also top up excise duty on that, it will not be affordable. And what's the implication to the economy? It means that the transport sector, for instance, will be affected, manufacturing sector, and the cost of production is going to go up, meaning that our goods are not going to be competitive as compared to the local imports. So it's a very good move. And hopefully by the time we then adjust this after every 2 years, we'll have considered the environment.
I see. Christine, your thoughts before we take a break?
On inflation adjustment, I totally agree with Edna, the essence of inflation adjustment on specific rates. But you know, it also assumes that even for manufacturers, they will always increase prices every year, which is not always the case. Because as a manufacturer, I have to consider, can I really pass this cost to the final consumer? I can't. So what happens? Manufacturers have had to absorb the cost of the inflation adjustment, any changes in Forex, because that's an additional cost, changes in raw materials. Therefore, the manufacturer is hard hit by inflation. So for the Revenue Authority to for the National Treasury to adjust every single year, it becomes extremely punitive. What I think is that we would have even preferred if it's after every 3 or 4 years, taking into account that the CS can still amend and change the specific rate in itself. So when you have that, you can imagine a year whereby he adjusts for inflation, he adjusts the specific rate, then an adjustment for inflation happens. The multiplier effect of that is extremely punitive on businesses. So something to consider. We need to make up our minds. Is it inflation adjustment or is it a review? And if we have to inflate for inflation, 2 years is definitely a good start. Hopefully, when we see the impact on that, we can get it after 4 years.
Robert.
No, I completely agree here that you see what you're also looking for, Julian, is stability and to enable these manufacturers plan ahead. So that, for example, you know that it's going to increase in the next 10 years. So what do I need to do? Do I need to grow my volumes? Do I need to, what do I need to do? And for me, if you look at the preamble to that report that we are discussing tonight, the committee actually did cite the National Treasury and say we really need this tax policy because that predictability of the tax environment is critical for investment and for increased revenue collection. So I join my colleague here to say that 2 years is definitely a good start. I think the sweet spot is somewhere between 3 and 4 years. And you know, like she says, if you increase the rates both ways, inflation and the base rate, then it's really a double hit. If you look at beers, for example, they have really been hit, and I'm quite happy about the outcome of the report and the recommendations that, look, you need to create a stable environment for these operators.
All right, that point by Robert takes us to another short break. We shall be back with a lot more of this conversation, focusing on the Finance Bill report of 2022. Stay tuned.
The WRC Safari Rally, Kenya's pride and joy, is coming even closer to you. NTV brings you the WRC Motor Expo live at the KICC on 3rd June 2022. Come and hang out with the rally drivers for adrenaline-filled and thrilling action. You don't want to miss the rush. A rare opportunity to get up close with your star drivers and their heavy machines. Only on NTV.
Our slogan is Kenya Kwanza. It is Kenya first, positions later.
Politicians will promise you anything. Musalia goes into Kenya Kwisha and he doesn't say that he's going to get 30% government.
He called us
Kwisha.
Kenya Kwisha. I called them Wakuzimia.
This was a team that used to be called the Sky Team. And these guys were rolling in money. Now, all of a sudden, they are bottom up.
It was deep state. Brother here is representative. He can
I
tell you the other men.
Okay,
I don't know. Hang on.
No, James. Let's be very clear.
When
Deep State is the National Security Advisory Council. It is called NSAC. The Deputy President sits on that one.
Made with 100% pure peanuts and a rich source of omega-6, helping you grow healthy and happy kids. Buy and enjoy Blue Band peanut butter at reduced prices today. Made possible through local farming in Kenya.
Welcome back to this conversation on Business Redefined. We are unpacking the Finance Bill report of 2022. Part 2, we're discussing issues regarding excise tax, and we began by focusing on this issue of the proposed inflation adjustment to take place once every 2 years as opposed to every year, and some merits have been tabled. But I have a question, and this question goes to Edna. Even if you do it once every 2 years, won't it imply then we have the accrual effect, which on a net basis should be just the same as annual?
So, Julians, yes, there would be that accrual basis, yeah, which is going to escalate the prices. But I think the broader concept here is, should we be increasing taxes every year, or should we give stability to businesses and also to consumers? Because if you do it then on an annual basis, what that means is that we are increasing the prices of the final product. And from a business perspective, it means that the consumer or the customer who was buying that may not be able to afford that. If, say, you are buying 2 bottles of something, you probably will only buy 1. So that means that you'll have a reduction in your sales volume, and this will also consequently have a reduction in the tax collection. So I think we also need to look at it from a broader perspective, because if you do it after every 2 years, we'll be taking the price that was there in the 2 years ago, and then we'll apply the indexation the current indexation. So it might actually give some little reprieve to the final consumers, and the businesses will also have time to recover this cost over a period of time, because you don't also want to keep increasing your prices as a business year in, year out.
Okay. The indexation being referred to by Edna is basically the consumer price index, that basket which is assessed every month. Robert, one of the things which surprised many of us in the report was the position taken around the excise on betting. I think the proposal was to take it to 20. The committee argues, no, this sector is overtaxed. I don't think we've seen that before. Were you as surprised as some of us were?
Well, not really, Julians. And I think for the betting sector, there's somewhat of a reprieve. And if you think about it, you look at the report, some of the taxes that this sector is bearing, you're talking about 15% gross gaming revenue. You're talking about punters who win 20% withholding tax. You're talking about corporation tax on the company, the betting companies. You're talking about excise duty on the punters. So when you think about the whole remit of taxes that this sector is paying, it's quite a lot. And then you compare it with other jurisdictions. You go down to Tanzania, because we like comparing ourselves with Tanzania, which is a good country, by the way. And you look at it, it's got 18% GGR, tax on GGR. Kenya has got 15%, but then all these other taxes. You go to South Africa, I think it's about 20%. You go to the US, much lower, I think it's 23%. Yet they have been able to contain this sector. So I think what you know, for this sector, that was a real good reprieve. And by the way, Julians, you look at that report, again, the committee has cited that you're increasing these taxes barely 6 months after you increased them in the previous year. So I think it's important that we do two things as a country. One, we let some of these sectors self-regulate, or at least cede the regulation to other sectors. I don't think it makes sense to regulate the betting sector using fiscal tools. I think that is clearly not working. I think the sector can self-regulate better. And two, I think giving them a stable operating environment also allows them in the longer term to contribute more to the exchequer. If you think about, for example, the sporting that used to be sponsored by these betting companies, you know, the other day we had that MISA had to shut down because of financial difficulties. And what are our youth doing? So I think there's definitely a trade-off there that needs to happen. But for the sector, I think that was a really good outcome in terms of maintaining the tax regime.
All right, and again, for the sake of our viewers, GGR is gross gaming revenue for those who engage in betting. Let me come to CK. Your thoughts on this issue of betting?
I actually agree with Robert. I think what we are seeing is that government is actually using tax as a way of dealing with the issue. And I agree, it's definitely an area of concern. Government has actually said we really want to manage this issue of betting because of the adverse effects it has been deemed to have on maybe school-going children and also adults. But as opposed to focusing on tax, because as he said, the tax on betting, there's a 20% withholding tax on the waged amount. There's an excise tax on the staked amount. There's the tax on the top revenue. Capital gains tax, we've got the corporate tax, and also you as an investor, when you're getting your dividends out, there's a withholding tax on that as well. There's a lot of tax in that sector. Is that how to deal with the issue? Can we come up with ways to resolving the issue of betting as opposed to use betting to deal with the issue? You know, because you might actually not get the benefit you are looking for, and therefore the tax becomes a revenue generating mechanism as opposed to dealing with the betting issue.
Okay. Edna, I don't know whether you have any thoughts on that.
Yes. I have some thoughts on that. So this is a sector that has not enjoyed tax stability. If you're to go back to the last Finance Act, actually every year there's a proposal to tax the sector. Either we are removing something or we are adding something. So from a tax stability perspective, that is lacking, and it's not good from a business perspective. And as my colleagues are saying, probably it's time for us to now look at the Betting, Lottery and Gaming Act and see, can we come up with regulations targeting the marketing of these products? Because inevitably what is happening is that a lot of these players are then going offshore. And this is not deterring the youth from engaging in these activities, because they can still do this online. And as they do this, yes, we understand and we agree that there are also negative consequences to the economy, but also looking at the wider picture, these people employed individuals in the country.
Yeah.
So there are employment opportunities that are being lost. There are people who did business with them. So this is also being lost. So I think from a longer term perspective, we probably need to come up with regulations around the marketing of the activities.
I see. Let me come to Robert. And one of the issues which really stood out for virtually everyone following the finance bill was the proposal around 50% deposit when it comes to appeals. Let's start with this. What really was the import of that? Because the argument has been tabled that this was a way to try and disincentivize appeals on tax matters.
Okay. Yeah, thanks for that question, Julians. And globally, that rule is called pay now, argue later, because you're being asked to pay now, and then you go to the court to argue later. And from the policymaker's perspective, the thinking was, we have some disputes that are staying in the dispute resolution process, whether from tax appeals tribunal all the way to the High Court. We've got some disputes that are taking up to 10 years. And so we have Revenue Authority or the National Treasury not being able to collect these taxes for the next 10 years. And like Edna was saying, you then have to ask yourself, what is the value of a shilling today versus a shilling 10 years down the line? And so the policymaker's proposal was, why don't we ask taxpayers to put down a deposit for 50% of the amount that has been assessed before you can appeal to the High Court. Now, a couple of things on this, Julians. One, and we're seeing quite big amounts of assessments. You know, you're talking about assessments in the region of 20 billion. Now, if you ask somebody to put down 10 billion shillings, do they continue in business or do they put down the money? Yeah, that's the first question. And for a lot of businessmen, they'll tell you this is not feasible, because even to pay your salaries, you look at businesses that are owed monies by maybe say county governments or even the central government, and somebody is being assessed to pay VAT. What do? They have to shut down. And if you then look at practice in the East Africa region, for example, Tanzania, you've got 1/3, a requirement to pay 1/3. It's been abused, and there's evidence that it's been abused, because all I need to do is come and say, I've got a target of raising 10, and therefore I bill you 30 or I assess you 30 so that you can pay 10. Yeah. And I meet my target. So there's that concern. But more importantly is constitutionally, it impedes your right to access court, because what they're saying is that without this 50%, then you can't even go to the High Court. And remember, you've got only 30 days to appeal to the High Court. So 30 days, I go and look for the money from the banks and what have you, and before I have it, the time has lapsed. So what happens? So as a professional, I'm happy that the committee has looked at this and said, look, this will drain cash flows for businesses. Let's look for better ways of resolving disputes. And if you think about it, ADR has been performing so well over the last 4 or 5 years that it's been in operation. So why do we want to spoil, why do we want to fix it if it ain't broke?
So, ADR is alternative dispute resolution. Robert, please. You're on mass media. Siki, your thoughts on this issue?
Yeah, so actually this is one of the issues that was discussed the most by almost every single stakeholder who made a public participation, who participated in the process of making submissions. And maybe just to add to what Robert has said, you know, it's assumed that, for example, if I'm appealing from the tribunal to the High Court, now that there is no specific requirement under the law to make a deposit, I will just move forward. That actually doesn't happen. When I'm appealing to the High Court, if I have lost at the tribunal, I need to seek a stay at the High Court, not to actually pay that tax. And the judge has the discretion to either decide you'll put in a deposit or pay a certain amount of tax, or he says, I understand your financial position, it's difficult to pay this amount, and allow you to make your appeal at the High Court. So nothing is lost from a government perspective. The tax is still protected in its form. And yes, Robert is mentioning the thing is that there's the issue of safeguarding for inflation. But remember, the way the provision is, the money sits at central bank.
Yes.
No one is telling you whether the income actually or the interest being generated, whose interest that would be. That is one, you know. So would you rather have that money staying there or have the investor continue with business to secure your taxes in the future? So that's very, very important. Then secondly, you will notice that the way the provision was worded, it actually stated that it is the taxpayer to pay once he loses. What about instances where the Revenue Authority loses in instances of VAT refunds? Why is it that they do not have the same requirement? Really, is that really being fair? So I think for those reasons, I'm actually very happy that that proposal by the National Treasury was not considered by Parliament, because it will definitely impede taxpayers' opportunity to appeal. And then also from an ADR perspective, you know, there are things, Julians, that you really want determined in court. Issues of law. When you want to build a tax jurisprudence, there are some cases that have to go all the way to the Court of Appeal, and hopefully the Supreme Court, based on the nature of the case. You don't want all matters to be referred to ADR. You get, because you also want to build the jurisprudence in tax. So when you deter taxpayers from using that avenue because they have to put in a deposit, it definitely won't work well for what we are looking from a legal perspective.
I see. Let me come to Ed now on that point. I'll be coming to you on the VAT refunds. There are a number of questions here on VAT refunds. But Edna, your thoughts on this? Robert, you call it pay to play or what?
Pay to play.
Pay now, argue later.
Pay now, argue later.
Yeah, so thanks, Julians, for that. So this is one of the proposals, as Christine has said, where the entire business community unanimously rejected it. And besides the points that have been given by my colleagues, Robert and Christine, we also need to look at it from a business perspective. So the business will be faced with a decision. You have 50% that you need to pay. Where do you get this money from? Most businesses are actually going to go out there and borrow. So they're incurring an interest expense. But it is not clear with the way the finance bill was worded whether or not there will be earning interest on that. So ultimately what we are saying is that we'll be reducing the profitability of the businesses because they have an expense but they don't have a commensurate income relating to their borrowed funds. Secondly, the other complication was around the refunds. It's not easy to get a refund. It's very complicated. You may just want to apply for a refund and tomorrow you are told, no, there's actually this other liability that you owe the Revenue Authority, so we need to offset. So ultimately, the businesses will not have that cash flow into their business. And remember, this is a cash flow that is required from a working capital perspective. It is a cash flow that is also required for expansion of business. So it had very serious concerns, and I'm actually very happy that the committee considered this and rejected the proposal.
On this issue, a very good friend of mine from the manufacturing sector is asking, in the highly likely event, and I'm just reading verbatim, that this is actually brought back, because this report is going before the floor of the House, what options do we have? Can we demand that KRA also is faced with the same demands, that they also make a deposit in the event that they're the ones in appeal? Whom do I start with? Robert.
Okay, so the clear answer to that is that you cannot demand, because remember, this is going to be anchored in law. Like Christine was saying, because it's not anchored in law, it's only the taxpayer who is being required to pay this demand. And so in the event, and we really hope that it doesn't pass, but in the event that it passes, what we are likely to see is what we saw in Uganda. We are likely to see huge disputes going all the way to in fact, this is going to be a constitutional petition, because somebody will be saying, look, Article 48(1) is very clear that you cannot impede my right to access justice. Article 51, expedient access to justice. So you cannot impede that right. And in Uganda, the Constitutional Court in Uganda in the Fuel X case has ruled that that kind of a provision cannot stand. And by the way, the Ugandan Constitution, Article 30, I think it's Article 32, of their constitution is the equivalent of Article 48. Yeah. So there is case law that suggests that you cannot do that. But in the same breath, I think it's also fair to say that South Africa has adopted a different position on that issue.
I see. CK, your thoughts on this?
I think I agree with him. If, for example, it goes through, I see the issue just happening like what we saw with minimum tax. A constitutional petition will definitely be put in respect to this matter because of the impact it definitely has on businesses.
All right. Yeah. Edna, any thoughts?
No, I totally agree with the two of them. We've become a very highly litigious society, so I expect that this will also be challenged in courts.
I see. Someone here is asking, does the report say anything as far as VAT refunds are concerned? Whom do I start with? CK.
Okay. So, you know, the issue of VAT refunds has been something that has been a problem for many taxpayers because from a taxpayer perspective, cash is king. And therefore, when your refunds are held at the Revenue Authority or with government, it definitely has an impact on your businesses. And what we've seen is that there's been lots of development from a VAT refund perspective. The Revenue Authority has been speeding up on the audits in order to pay back taxpayers on time. It has always been a challenge because National Treasury's allocation does not match what taxpayers have actually put in, the refunds that are due to taxpayers. But also what we are seeing is amendments to the VAT Act in order to reduce such refunds. Like as Edna mentioned, the reduction of the zero-rated status of most goods and services, so that government refunds less and less, so as to deal with the issue of refunds. But in other instances, which I'll speak about, one that is very close to my heart, is on VAT on exported services. This issue of VAT on exported services results into refunds, and this is because the way the VAT Act was prior to June 2021, exported services was zero-rated just like exported goods. So I'll give you an instance, Mboko. I am a provider of services. If I provide services to a client in Tanzania, I'll treat that as an export of service. It will be zero-rated because of the destination principle. Tanzania has a taxing right to apply the VAT from that perspective. Now, because of the issue of refunds, exported services were moved from zero rating to exempt. Yeah. That means that if I'm exempted, as Robert explained, I cannot claim my input VAT that has enabled me produce those services. So it becomes a cost of doing business. Yeah. So the change has managed the issue of refunds, but it is not dealing with the issue at hand. You know, and it feels very sad that me, who's an exporter of a service, I'm getting a different VAT treatment from an exporter of goods. We are getting into the service industry. That's, I mean, we are dealing more with services and breaking the, you know, brick and mortar is actually more or less coming to an end. Yeah. So in light of that, I feel discriminated because my services are being treated as exempt. So it was done that to solve the issue of VAT refunds, but it affects taxpayers because, like now, I'd rather render the service in Kenya because all my VAT from rent and others, I can claim them, as opposed to rendering the service in Tanzania. And if that month I just did work offshore, I can't claim all my input VAT. It becomes a cost on business. So there's definitely some work happening from a refund perspective. I'm not very happy about the changes that are happening with respect to changing tax rates in order to deal with the issue. Let's streamline the process. Definitely that will help. But I'm happy to see everything that the Revenue Authority is doing to facilitate refunds. But I know because of the pot they get from National Treasury, it's not as easy as we would expect it to be. Before I come to Edna on the issue of VAT refunds, let me stay with you for a minute. Would it be of help if the law went as far as exclusively providing for a prescription or a definition around exported services? 1, 2, 3 are the ones which fall within this category. Actually, that was the issue at hand. Because the reason as to why there's been a contention of what an export of service is, Section 2 of the VAT Act states that as an exported service is a service consumed or used outside the country. So depending on how you look at who's the user and consumer of the service, if you deem that the user and consumer of the service is a local person here, you will want to charge VAT. If the use and consumption is outside, that becomes export of service. That's what we should have done, Mboko. We should try as much as possible, provide clarity with respect to what use and consumption is, so that it clearly defines what an export of service is, as opposed to changing it to exempt just to prevent Christine from claiming the input VAT. Edna, this issue of VAT refunds, we keep on having this conversation. How do you assess the state of play? Are we making progress?
So, Julians, first of all, why do we have a challenge with VAT refunds? And not necessarily just the VAT refunds, but generally tax refunds. And the challenge is because the Revenue Authority is going to collect taxes. All these taxes are going to go to a National Treasury account. So when you apply for a refund, you then KRA now has to go to the National Treasury and justify why they need an allocation. Maybe we need to also see what other jurisdictions are doing to streamline their process. For instance, like South Africa pays very quickly within a period of about 3 months. So what is this that they are doing differently? From a Kenyan perspective, I know the challenge has been around the Public Finance Management Act. So is it time for us to also look at it and see, should we be giving some allocation to KRA so that in whatever they are collecting, whatever represents the refunds is kept aside.
Yeah.
If a taxpayer now wants to come and get the refund, this can be fast-tracked. And then also from an administrative perspective, another thing that South Africa does is that they fast-track the refund process. They may not necessarily even come to audit you, but eventually when they audit you and there are some gaps in your compliance, then you're levied with penalties and interest. So that is a way of government also getting compensated for that money they paid you that you were not supposed to be paid in the first place. So maybe those are some of the broader discussions that we need to be thinking about.
I see. Robert, any thoughts to add?
No, actually, and the point that Edna has made is very critical, because I think our problem is an architectural one, because under Section 18 of the Public Finance Management Act, you cannot access those funds once they go to the consolidated fund. So I think it's a function of can we get Revenue Authority to access these funds in order to make the payments? And like she says, you go to Rwanda, you get your VAT refunds in 30 days. You go to Ethiopia, you get your refunds in 45 days. So surely, why can we not do that in Kenya?
I see. Siki, let me come to you. Capital gains tax, I think the proposal from Treasury was 15%. The committee is proposing 10%, right?
Yes.
Someone is asking here, what does this mean, especially for those of us who deal in securities?
Okay, so capital gains tax, this is something that has been long coming. That we expected an increase, and this is because when you look at our neighbors, the tax rate is actually pretty high. In some countries, it's actually at 30%. So we saw that coming, but you'll realize for those jurisdictions where the tax rate is high, they adjust the capital gain for inflation, yeah, so that you eliminate the impact of inflation from the capital gain. Yeah. We call it indexation. So that definitely helps, so that you're not dealing with a significant spread, yeah. So capital gains tax is on the value between the transfer value and the adjusted cost. So the adjusted cost is how much you bought that property for, the cost you've incurred to bring it to what it is. The transfer value is the value for which you're selling. So the difference is what is usually subject to capital gains. So the current rate is 5%. The proposal was to increase it to 15%. Yeah. The committee has recommended at 10% without factoring in indexation, because indexation is a process that will, I mean, it's not an easy fix, and therefore that will take time to be crafted. Now, that's mainly on property, movable property. On shares, there is a rate, but we don't look at it from shares that are actually trading on the stock exchange. The rate is actually not a CGT rate. It's at about 3%. Yeah, it's actually exempt. Yes, it's actually exempt from capital gains. So that's not being captured in this instance. We are looking at mainly on property. There are definitely exemptions provided under the first schedule, that's paragraph 36. So for example, if you're transferring a house, or you're selling a house which you've lived in for a period of more than 3 years, that's exempted. There's some specific exemptions when it comes to that.
All right.
Yeah.
Robert, anything to add to that on CGT?
No, and I think that proposal of CGT is exactly the reason why we really need a tax policy and the frequency of these adjustments. Because if you think about it, 5% came in 2015. Mm-hmm. So now, 7 years down the line, you want to triple it. No, let's go slowly. And I think that's what the committee is saying. Guys, let's go slowly. Actually, the Institute of Certified Public Accountants recommended 7.5% as a halfway house. But I suppose the committee in its wisdom has decided to adopt 10%, which is still high, but considering where you're coming from, but I think is a good starting point.
All right. Edna?
Yes. So the increase in any tax rate, whether CGT or any other proposed tax rate, should be gradual and not very steep. Now we are talking about double or triple. The finance bill wanted to triple it. The compromise is double. What is the impact of having very steep increases? The government is not able to necessarily gauge the impact of that on revenue collection. So, and an increase in tax rate does not necessarily translate to an increase in tax collection. So what will happen is that investors will now start rethinking their transactions. So for instance, you wanted to dispose of a property, and all of a sudden now you realize that the capital gains tax rate has gone up to 10%. So you may want to rethink that and hold back. So what ultimately happens is that the government then loses out on that revenue. So, and as my colleagues have said, from a capital gains tax perspective, if you are to benchmark even with the East African Community state countries, the state members, all of them have that indexation allowance to cushion taxpayers against paying taxes on inflation. Let's just pay tax on the real appreciation of the property. So I do hope that this is one of the things that the National Treasury is going to embark on.
I see. There is a question here around what should media houses expect? And I think the sentiment here is largely around there was a proposed 15 excise on some sort of advertisement.
Yes.
The compromise, I think, has come to 5.
Yes.
CK, let's start with you.
That was definitely a very interesting one, Amboko. And the proposal was to increase, actually it's not an increase, it's a new tax on marketing related to alcohol, tobacco and betting, such that that will now be subject to a 15% excise tax. And I think that's what really worried me. The extent to which we are taking excise tax, you know, it has become more of we need revenue. Where can we put the tax? Yes, I agree, these items are subject to excise tax, but honestly, from an advertisement perspective, those are already regulated. I mean, you guys have a code as to how you operate from an advertisement perspective on some of these items. And therefore, would excise duty really deter you from advertising? It will be an additional cost to this industry, because the excise tax, what will happen is that you will increase your cost of marketing to cushion you from the impact of the excise tax. So the manufacturer of the excisable goods, these are specific to tobacco and alcohol, will need to take up that cost, hitting their P&L even harder. Yes, so the consensus is a 5%. And as I said, Amboko, it worries me when excise tax takes that direction, that we are looking for ways of putting in excise tax in order to increase revenues. We should really reconsider the place of excise tax as a tax in Kenya.
Robert, in case a media house is wondering, how do we prepare for this in terms of we've never been subject to this tax before? How do we prepare for it?
And that's the point that we were making earlier about Kenya being ahead of the curve in terms of the excise duty. But, you know, turning back to the issue, actually, if you look at paragraph 52 of that report, the recommendation is that you delete that proposal. So the recommendation is actually not even coming down, it's to reduce it. And the rationale there is, look, this is a sector that's also already self-regulating. Why do you want to interfere using fiscal tools? But to answer your question, any finance director or finance manager of a media house, assuming that proposal is not accepted by the committee of the whole house, then what it will mean is that come 1st July 2022, you need to apply to the Revenue Authority to be licensed as an excise duty service provider. And then after that, every time you get an advertising invoice, or you want to issue an advertising invoice, 15%, 15% excise duty goes. And the thing about being licensed, in all seriousness, being licensed under the Excise Duty Act is a real challenge in terms of the administrative burden. You know, you've got your monthly returns, the elements about inspection of what you're doing. It's a really controlled. Don't be surprised if we hear that now there's also excess stamps that you need to affix on your invoices. I mean, it's really, yeah.
Edna, any thoughts on this, please?
No, my colleagues have covered it. But maybe just looking at the products that are being targeted advertising of alcohol, tobacco and betting, it also goes back to the earlier discussion we had around regulation. So should we then be using excise tax to regulate the consumption of these products? Or should this be probably a totally different way? Is there a different way of regulating this sector? Because as we say now, this burden is being shifted to media houses. And I guess the proposal is to discourage advertising, maybe for the sake of the youth, so they're not able to start using these products. But is there a better way of actually achieving the same result?
I see. We have 2 minutes to a break, and let me start with CK here. Very quickly, someone is saying, so much focus on VAT and excise. Anything in the report that we should know about income tax?
From an income tax perspective, DST, there was a proposal, digital service tax.
Yes, please.
Yes, the bill had proposed moving the digital service tax from 1.5% to 3%. That's actually double. You know, I mean, we've gotten to that level where we are doubling taxes in a year, you know. I mean, that causes a lot of instability. But what we've seen is that the report, the committee has actually rejected that proposal. And what the service providers in this industry are arguing is, give us time for us to see what the impact of this tax has been. How much revenue have we managed to raise over a couple of years before you even propose to increase it? You know, so we need to have that certainty. For them, it was definitely a new tax, that, and on the consumer, they might have actually pushed that cost on the consumer, and therefore their prices have become more expensive. Introducing another tax, an additional tax, that's the additional 1.5, and that's passed to the end consumer again, that would actually may result into a decline in volumes or the service being rendered, resulting to even a decrease in taxes. So what the stakeholders on this one was asking for is, give us some time to really appreciate and see the impact of DST over a couple of years before you increase it to by another 1.5%.
Right, and that point by Christine Kayama takes us to another break. When we come back, we shall be getting the closing remarks as well as the very critical conversation around this bill is before the floor of the House, but the House doesn't have too much time. What are the options ahead? Stay tuned.
Who is a true partner? They go out of their way to help you. They do not hesitate to go the extra mile. And they're always there standing beside you. They step in when you need them the most. Because a true partner is a partner kwa ground. KCB Bank, go ahead.
Unajua ni familia when sweet surprises turn a frown into a smile. Ilara, part of every familia, vile tunaipenda.
The first winner of the Champions League is again the most recent winner of the Champions League. Which means Real Madrid is the champion of Europe for the 14th time. That is some achievement, and this is the Football Review.
We understand in life, the things that you desire the most are within reach when we unlock possibilities. UAP Old Mutual is now Old Mutual.
Utararua suti. Yaye. Kwani hujazoea suti? Tembea na decorum.
Hata mtu wa boda
anaingia kwa Harambee.
Mama wa soko
Harambee Sacco.
Mwalimu
Harambee Sacco.
Polisi
Harambee Sacco.
Uamuzi ni wako.
Harambee Investment Cooperative is a brainchild of Harambee Sacco. Since we started in 2014 to date, we've given over 1,000 title deeds.
Wow.
We have sold plots in Nairobi, Kantafu, we've sold in Nakuru. We are now in Eldoret.
Jamani, nini mbona mnalumbana?
Sasa mwanamke anafanya kazi ni kama amelegea. Ni mimi ndo kuamua Sera atapumzika lini kwa hii nyumba.
Hatumfuti Sera, sawa?
Sasa sote tumekuwa rembo wako. Ni mzee unamtaka? You can have him.
Richard, kuna kitu nataka kukuambia.
Red Bull gives you wings.
In the last 2 years, Centum Real Estate has completed and handed over 600 plus homes in Nairobi and Vipingo. Riverbank at 2 Rivers, comprising 1, 2 and 3 bedrooms plus DSQ apartments, is among the move-in ready homes available for sale from 15 million Kenya shillings and rent from 120,000 Kenya shillings per month. The apartments present the epitome of live, play, shop and work, luxury living within the same complex. The Riverbank apartments assure you state state-of-the-art security in a lush landscape with exquisite views. Call +254 713 877 777 for details.
Since the pandemic, all mums know to be cautious of the many kinds of everyday germs that spread easily. Get peace of mind and protect the ones you love with the power of Dettol bar soap. It cleans and protects from up to 100 illness-causing germs. So no matter what type of mum you are, trust Dettol.
Dettol antibacterial soap 60 grams is now 50 shillings.
Jina langu ni David Waku, mimi ni professional golfer. Namshukuru sana baba yangu, alinijulisha kwa mchezo wa golf na kunipa ujasiri wa kuwatambulisha wengine kwa mchezo huu. Nilipoanza nililenga vizuri nafasi yangu na kuonyesha ujuzi na kutimiza ndoto zangu. Mwanzo nilitishika, lakini nilipopata nafasi ya kucheza mchezo huu maridadi, nilipata ujasiri wa kuutumia vyema. Kama yalivyo maisha, golf inahusu uvumilivu na udhabiti. Ili kushinda, nilihitajika kuweka juhudi na kufanya kazi kwa bidii zaidi kuliko wengine wote. Uwezo wa kuwa bingwa ulikuwa ndani yangu, na kila nilipolenga na kupiga, ndivyo nilizidi kukaribia nia yangu ya kuwa mfalme wa mchezo huu.
David Wahu alibadili kila jaribio lake kuwa fursa. Anza safari yako mwenyewe ya mabadiliko katika Safaricom Golf Tour.
This is NTV.
Tonight, electoral violence is increasingly a likelihood.
61% of Nairobians eat 1 meal a day. 65% of Nairobi lives in the slums of our city.
We list the hotspot counties and what NCIC has flagged in them.
Cases of transfers without one's knowledge shall be investigated.
A leaked IEBC memo sparks jitters. The commission is not pleased. We speak to the CEO live on this broadcast. Waluke, the corruption convict, cleared to run for office. EACC chimes in on the integrity position amid concern. And the battle for Nairobi and Mombasa's top jobs. And the place of the cities in national politics. With all due respect, there is need for changes in the city.
Our slogan is Kenya Kwanza. It is Kenya first, positions later.
Politicians will promise you anything. Musalia goes into Kenya Kwisha and he doesn't say that he's going to get 30% government.
He called us
Kwisha.
Kenya Kwisha. I call them Wakuzimia.
This was a team that used to be called the Sky Team. And these guys were rolling in money. Now, all of a sudden, they are bottom up.
It was deep state.
Brother here is representative. You can
I
tell you the other men.
Okay, I don't know. Hang on.
No, James. Let's be very clear.
When
Deep State is the National Security Advisory Council. It is called NSAC. The Deputy President sits on that one.
Since the pandemic, all mums know to be cautious of the many kinds of everyday germs that spread easily. Get peace of mind and protect the ones you love with the power of Dettol bar soap. It cleans and protects from up to 100 illness-causing germs. So no matter what type of mum you are, trust Dettol.
Dettol antibacterial soap 60 grams is now 50 shillings.
New Even and Mad Dog Spot Corrector. The power of vitamin C. Bye-bye dog spots.
Hakika jua ya kwamba kitu kiwezacho kukutenganisha na upendo wa Mungu, iwe kifo, uhai, malaika, nguvu zingine za mbinguni, ya sasa wala yatakayotokea baadaye, wala mamlaka wa ulimwengu wa juu, au wa chini kabisa, hakuna kiumbe chochote kitakachoweza kukutenga na upendo wa Mungu katika Kristo Bwana wetu.
To get Amazing Love by Betty Precious, dial *812*801#. Skiza na Nation.
Made with 100% pure peanuts and a rich source of omega-6, helping you grow healthy and happy kids. Buy and enjoy Blue Band peanut butter at reduced prices today. Made possible through local farming in Kenya.
Welcome to the tail end of this conversation on the Finance Bill 2022. We have tons of feedback here. Unfortunately, my director, Jackie, tells me I only have 10 minutes to go. So let's just get straight into this conversation. And let me start with Edna. We took the break when we were discussing the issues around income tax proposals in the report. CK covered the issue of digital services tax. Any others?
Yes, so there's one that really stands out for me. It's around investment allowance. The finance bill proposed that if you're investing outside of Nairobi and Mombasa and your investment is more than 250 million and you are not outside of Nairobi and Mombasa specifically because your business, your business could be set up elsewhere other than Nairobi and Mombasa, then that investment allowance would have been taken away from you. So what the report has said is that this is very discriminative. Anybody who is investing outside of Nairobi and Mombasa should be accorded equal treatment. And so long as you meet the threshold of 250 million, then you are eligible to this investment allowance. Yes.
So it's a step in the right direction,
yes.
In your view. I see. Robert, let me come to you. One of the sticky issues we must deal with right now is the fact that the timeline within which Parliament has to deliberate and pass this bill is really constrained. What is the scenario looking like?
Yeah, that's a good question, Julians, because today is 31st of May, yes. And Parliament adjourns for the last time, what the parliamentarians call sine die. It adjourns sine die. It rises for the last time on June 10th, which is next week Thursday, I believe. Yeah, next week Thursday, yes. So what that means is that Parliament has to dispense with the business that is before it, including passing the Finance Bill 2022 into an Act of Parliament. Because remember, Treasury has projected some of these revenue estimates starting 1st July 2022. So really, we don't have an option. And I think what's going to happen is what we saw possibly 2 years ago, where Parliament went late into the night to discuss these proposals. And because under the Public Finance Management Act, this has to be signed into law by the President by 30th of June, yes. I don't see any leeway for that. And so what I expect is either a very extended debate late into the night by Parliament, or perhaps the Committee of the Whole House adopting quite a number of these proposals by the committee, and taking that about, so that the finance bill is passed by Parliament, transmitted to the President for signature, and so that it can be published and become effective 1st July 2022. So I really, based on the timelines, it's a very tight calendar for Parliament. And if you watch the Bunge today, there are some certain other businesses that were also deferred to Thursday. Yes. So it means really the period for debating is quite restricted. I think it's going to be an interesting one because for sure we must have the Finance Act.
By June 30th?
By June 30th, by law.
I see.
Yeah.
CK, any thoughts on this?
No, I think I'm keenly waiting to see the Finance Act. And I'm hoping to see some of the proposals, actually most of the proposals that were made by the committee in the Finance Act. And yes, the duration is really, really short. I know Parliament could be called back to deliberate on it if need arises, but still that gives us a very short window, taking into account that the Finance Act, based on the Public Finance Management Act, has to be out by 30th of June. So we are keenly watching to see that, but I'm very pleased by the level of engagement that has gotten us where we are, because a lot of the views of the common mwananchi were taken into consideration because they played a critical role in public participation. So even for the members of Parliament who are deliberating on these issues, they certainly represent that common mwananchi. So we hope to see the proposals, some of them that were made by stakeholders, finding a place in the Finance Act.
I see.
Yeah.
We have 5 minutes to go. Let me get to the closing remarks, and let me start with Edna.
Yeah, so Julius, my closing remarks are that I really hope that the House is going to adopt the report of the Finance and National Planning Committee of Parliament, which was very well thought out with very extensive public participation. And just like my colleagues have said, I hope that the finance bill is going to be assented into law before Parliament dissolves.
Edna, maybe just a quick write-up to that. If it's adopted as it is, how do we raise 50B?
I think when you talk about 50B vis-a-vis the target of 2.1 trillion, that's about 2%. So I'm sure the Revenue Administration can just tighten a few leakages here and there, and they'll be able to collect part of that. Because this financial year, the coming financial year rather, the Revenue Authority is supposed to grow their revenue target by 17%. Yeah. So 2% vis-a-vis 17% is very small.
Robert, your closing thoughts.
Yes, thanks, Julian. So I think the message, if you look at that report, I think the message that Parliament is passing to the Executive and the National Treasury is, look, guys, we think you need to think a little bit harder in terms of the proposals that you bring to us next time. And really, we want you to think about expanding the tax base so that we are not going, revisiting the same issues every so often. And I think that's a good one because the starting point, like we've said, has to be the national tax policy. So let's start with getting the national tax policy out. Then we can debate about how do we increase the number of taxpayers in this country so that we can even possibly bring down some of these tax rates. Because at the end of the day, if you look at that, the preamble, Kenyans are really complaining about the cost of living. So how do we do that? And so for me, I think this has been a really, really good one. We must thank Parliament for a job, I think, very well done throughout this time in terms of the fiscal proposals, engaging on fiscal proposals. And hopefully the Parliament that we get next time can be as active and as focused on these matters, because as a country, we all need to take care of this economy.
Yeah. Sike, your closing thoughts.
What comes to mind for me is the place of businesses, individuals in shaping the tax legislation in Kenya. As I've said, I was really impressed to see all those individuals and all those entities and association on behalf of their members coming out to really give their case with respect to the proposals that were in the finance bill. That was definitely for me, I'm actually very impressed by that, because we can't sit back and complain that taxes are so high, but we are not doing something about it. Sometimes we have issues with the Revenue Authority and they'll tell you, Christine, the law is what it is. And you're thinking, okay, I have an opportunity every single year to have the law changed based on what I feel has aggrieved me as a business person. So I was definitely very happy about that. And I'm hoping that we can focus on long-term sustainability from a tax perspective. Let's try and reduce the year-on-year changes. Let's see, and maybe one day we will have an instance whereby Amboko businesses are sitting with KRA or with National Treasury and telling them, here is my business plan for the next 5 years. And the government asks the business, what is it that I can do to ensure that your revenue projection of 30% after 5 years will happen? Because if that happens, the taxes will increase gradually over the years, and it will be a win-win for both businesses and government.
Thank you so much to my panelists. That's Edna Gitachi from PwC, Robert Orero from Echiban, and Christine Kahema from Alpha Tax. Thank you so much for your time and for such a protracted discussion on the Finance Bill 2022. Remember, this matter is the big issue before the floor of the House, because we have a financial year either way starting on the 1st of July this year. So we shall be keeping a close watch on this. There's a question here around minimum tax. That's a whole different conversation, maybe for next time. News is up next with James Mart, who shall be focusing on With All Due Respect, so stay tuned.